Part 1. The beginning of the investment journey. Description. Introduction to the world of investment and the initial struggles, doubts, and hopes of new investors. Hello and welcome to Flow Decoded. Tonight we're diving into a journey that's full of challenges but also incredibly exciting. Investing. Have you ever wondered if investing could change your life? Could you build significant wealth from smart decisions? Or will you face struggles and maybe even failure? That's a big question, and it's one that a lot of people are thinking about. Tonight, we'll explore that journey from the very first steps. You step into the world of investing, and let's be honest, it's a little scary. The first steps are full of anxiety and uncertainty. You're diving into financial markets, but everything seems so complicated. You're looking at terms like stocks, bonds, ETFs, and investment funds, and it feels like you're staring at a wall you have no idea how to climb. But don't worry, this is exactly what every first-time investor goes through. The confusion, the frustration, it's all part of the process. Questions are popping up in your mind. How can I invest effectively? How do I distinguish between a solid opportunity and a trap? Do I have enough knowledge to succeed? You start wondering if investing can really change your life. Will it bring you the financial freedom you've always dreamed of? So you start reading books, watching videos, taking online courses, and surprise, you realize that investing isn't some game of chance. It's an art. It's a skill you can learn. It's not a sprint. It's a long journey where patience and determination play key roles. You understand that success doesn't come overnight, but with a solid foundation of knowledge, you can start small and build over time. Now, the big question is, where do you start? What's the first step? The truth is, there's no easy answer. But here's the good news. You're not alone in this. You'll be learning step by step, strategy by strategy, right here with me. So, before you get comfortable, take a second to like this video and subscribe. But only if you really enjoy what I'm doing here. Don't miss out on future stories. Hit the like button, subscribe to follow along, and get ready for the next video. Now, step 1 of the process is complete. I've outlined part 1 and started with the introduction. Once you confirm the tone and style work for you, I can move on to the next parts and continue developing the entire story. Just let me know if you need anything else. Part 2. Overcoming the fear of investing. You've just dipped your toes into the world of investing, and now comes that feeling. It's like a sudden wave of anxiety, right? First-time investing is intimidating, no doubt about it. The thought of making a mistake, losing money, it's enough to make anyone hesitate. You look at the numbers on your investment screen and everything feels overwhelming. The world of finance seems gigantic, like you're standing on the edge of a cliff with no idea how deep the fall might be. But here's the thing. You're not alone in feeling this way. In fact, every investor has experienced the exact same thing. It's a natural part of the process. Fear is not your enemy. It's just a reaction to the unknown. When you face something new and risky, fear creeps in, and that's completely normal. But remember, fear can be a motivator too. It can push you to be more careful, more informed, and more disciplined in your choices. The key is understanding that fear doesn't have to control you. It's just there to tell you to slow down and learn. And once you do, you'll see that fear can be a valuable tool. It forces you to seek out knowledge, and knowledge is your armor in this world of uncertainty. So, what's the first step? The first step is to reduce the uncertainty around you. Start familiarizing yourself with the tools and assets you can invest in. Learn about stocks, bonds, mutual funds, and ETFs. These tools will help you spread out your risk instead of putting all your eggs in one basket. Here's the truth. You'll still feel afraid, and that's okay. Fear never completely goes away, but now you're armed with information. You understand that no investment comes without risk, but it's how you manage that risk that's crucial. You realize that instead of running away from investing because you're afraid of losing, you can learn to coexist with fear and use it to your advantage. Your next step? Start simple. You can dive into index funds, for example, investing in a diverse pool of stocks so you don't have to pick them out one by one. Not every investment has to be a giant leap. It's about taking small steps, building your wealth slowly but surely. Part 3. Success stories from famous investors. Now that you've started getting the hang of investing, it's time to learn from those who've gone before you. There's no better way to inspire yourself than by studying the success stories of people who've faced the same challenges and overcome them. You start to realize that investing is not a new idea. It's been practiced by some of the world's wealthiest and most successful people. Let's start with Warren Buffett, often regarded as one of the greatest investors of all time. His story is a classic. He started young, faced failures, but kept to his long-term investment strategy. Buffett's core principle? Buy and hold. The idea is simple. Invest in companies with strong foundations and hold those investments over time. That patience paid off, and it transformed him into one of the wealthiest individuals in history. And then there's Elon Musk. You probably know his name, right? A visionary in the tech world, especially in fields like space and electric cars. But Musk's journey wasn't easy. Tesla and SpaceX were on the verge of collapse several times. Musk encountered major setbacks and failures early on. Yet he never gave up. Instead of seeing these failures as obstacles, he saw them as learning experiences. He didn't let the hardships define him, he turned them into stepping stones that led to his success. But Buffett and Musk aren't the only ones. Another great example is Ray Dalio, the founder of Bridgewater Associates. He went through countless failures before he built one of the largest hedge funds in the world. Dalio's story teaches us an important lesson. It's not about avoiding failure, it's about learning from it. His approach to risk management and creating a system for decision-making is something every investor should learn from. What can you learn from these stories? One thing that stands out about Buffett, Musk, and Dalio is their resilience. They stuck with their strategies even when things didn't go according to plan. They learned from their mistakes and kept moving forward. This is a vital lesson for you. Don't be afraid to fail, but use failure as a stepping stone. The road to success in investing is rarely straight. It's full of twists, turns, and setbacks. So as you continue on this journey, remember the stories of these great investors. They didn't achieve success overnight, and neither will you. But with patience, resilience, and a willingness to learn from failures, you'll get closer to your goals. Part 4. Basic Investment Strategies. You've learned about the challenges, the fears, and the stories of those who succeeded. But now, it's time to focus on something equally important: the strategies that will guide you on your journey. If investing were a map, strategies would be your roadmap. Without them, it's easy to get lost. So, let's break down some basic investment strategies that will help you navigate this world with confidence. The first one you'll come across is long-term investing. You've probably heard this term before, but what does it really mean? Long-term investing is all about holding your investments for years, sometimes decades. Think of it like planting a tree. You don't expect to see the fruits overnight, but if you take care of it and let it grow, eventually it will give you something incredible. Take a look at Warren Buffett's strategy. He's a big proponent of long-term investing. He focuses on companies with strong fundamentals, and he doesn't worry too much about short-term fluctuations. Instead of jumping in and out of stocks based on market conditions, he lets his investments compound over time. That's why his wealth continued to grow year after year. The next strategy is diversification. You've probably heard the saying, "Don't put all your eggs in one basket." That's exactly what diversification is about. It means spreading your investments across different asset classes, like stocks, bonds, real estate, and even commodities like gold. By doing this, you lower your risk. When one market is down, another might be up, balancing out the potential losses. You also need to consider index funds. Index funds are a fantastic option for beginners. Rather than picking individual stocks, you invest in a fund that tracks an entire market index, like the S&P 500. This strategy gives you exposure to a wide variety of companies, so you don't have to worry about picking the next Apple or Amazon. It's a great way to spread out your risk and still benefit from market growth. And of course, there's risk management. You've learned that there's no such thing as a risk-free investment, but the goal is to manage that risk effectively. For example, never invest more than you're willing to lose. Understand your risk tolerance and use strategies like stop-loss orders to protect your investments if things go south. It's about finding the balance between taking smart risks and keeping your emotions in check. So, how do you put all this into action? Start small. Maybe start with an emergency fund first. Once you have that in place, consider setting clear financial goals. What are you investing for? Retirement? Buying a house? Having financial freedom? Knowing your goal will help you pick the right strategy. Start with small amounts. You don't need to be rich to start investing. Small, consistent investments can grow significantly over time. It's about creating a habit and being consistent. And don't forget to keep learning. The world of investing is always evolving, and staying educated will help you make smarter decisions. In summary, you don't need to have all the answers right away. Long-term investing, diversification, index funds, and risk management will be your foundation. Stick with these strategies, and over time, you'll see your financial situation start to grow. Part 5. The Temptations in the Market. As you continue your journey into the world of investing, you'll realize something important. The financial markets are not a calm, serene place. Instead, they are like an ocean, constantly moving with waves that go up and down. And amidst these waves, you'll face temptations, those enticing opportunities that might seem like a dream, but could also come with a lot of hidden risks. The first temptation you'll encounter is the allure of hot stocks. You've probably heard stories of people making quick profits by jumping into the hottest stocks. You see news headlines about stocks skyrocketing, and suddenly you feel like you're missing out. You might be tempted to dive in right away, but here's the question. Do you really understand these stocks? Are they being driven by real value, or is the market just inflating their prices? The advice here is simple. Don't get swept up in the hype. Famous investors like Warren Buffett often emphasize that investing is a long-term game. Quick gains can be exciting, but they are often fleeting. Stocks that shoot up in price quickly may very well be overvalued and could crash just as fast. Buffett's strategy is about finding companies with strong fundamentals, ones that will continue to perform well over the long run. It's not about chasing after the next big trend. Another major temptation is greed. You may have seen your stocks grow rapidly, and now you start thinking, what if I could make more? This is where greed can take over, leading you to take risks that aren't aligned with your strategy. You might decide to throw all your money into a single stock, thinking it will continue to rise, but greed often clouds judgment. It can make you forget about your original investment plan and push you toward decisions that could be dangerous. Let me give you an example of greed. You see a small investment giving massive returns, and suddenly, you want to invest everything you have. But without properly assessing the risks, this could result in a huge loss if the market turns against you. To avoid this, always remember, investing should be based on logic and strategy, not emotions. The third temptation is news and emotions. We live in an age where information is everywhere. News about the market, politics, or any big events can flood your feed. These stories often generate emotional reactions. For example, if there's news of a market crash, it might make you panic and want to sell everything. Or if there's a political event that causes uncertainty, you might feel the need to act quickly. But here's the thing, the news doesn't always give the full picture. Yes, there will be market dips, but they don't always signify disaster. Often the market will rebound. If you act based solely on emotions, you might sell your investments at a loss during a temporary downturn. The key is to stay calm and stick to your strategy. Don't make rash decisions based on short-term news. Remember, investing is a long-term journey. So how do you fight these temptations? Follow your investment strategy. Stay true to the principles that you've set for yourself, no matter what the market is doing in the short term. Set clear financial goals for yourself so you know exactly what you're working towards. Patience is a huge part of success. Be patient and don't let your emotions dictate your decisions. Another tip, don't obsess over every little movement in the market. Check your portfolio regularly, but don't get so caught up in daily fluctuations that you make hasty decisions. Stick to your plan, keep your goals in sight, and let your investments grow steadily over time. In summary, the temptations of the market are real, but they don't have to control you. Stay focused on your long-term strategy, don't get swayed by greed or fear, and use patience as your tool to navigate the waves of the market. Part 6 on Understanding Investment Psychology. As you continue your journey, you begin to realize that investing isn't just about numbers and charts. There's another side to it, one that's often overlooked, your own mindset. This is where the psychology of investing comes into play. The way you think, the emotions you feel, and the decisions you make based on those emotions can have a huge impact on your success or failure. Think about it. How many times have you felt anxious when your investments weren't performing well? Or maybe you felt a rush of excitement when your stocks started to rise. These emotions are perfectly normal, but they can cloud your judgment if you don't understand how to manage them. Investment psychology is a mix of greed and fear. These two emotions will be your biggest challenges as you progress. When the market goes down, you might panic and want to sell everything to avoid further loss. That's fear talking. On the other hand, when the market is soaring, you might feel like you're invincible, thinking that you can make endless profits. That's greed taking over. Fear of loss is natural. Everyone experiences it. But the key to overcoming fear is to understand that market fluctuations are normal. Ups and downs happen all the time, and they don't always mean a disaster is coming. If you sell out of fear during a market dip, you might lock in your losses and miss out on future gains when the market rebounds. Now, let's talk about greed. It's easy to get swept up in the excitement of a stock that's shooting up in value. You might think, if I just invest more now, I'll make even more money. But here's the catch. Greed often blinds you to the risks. Remember that investing is not about hitting a home run every time. It's about making steady, informed decisions and not letting emotions push you into reckless actions. To manage these emotions, you have to stay grounded. Don't make impulsive decisions based on short-term market movements. Instead, focus on your long-term goals and the solid foundation you've built. If you feel fear creeping in, remind yourself that investing is a marathon, not a sprint. If you feel greedy, take a step back and ask yourself, does this decision align with my strategy? One of the most important things you'll need to develop is emotional control. Learning to stay calm and stick to your strategy when everyone around you is panicking or celebrating is crucial. The ability to separate emotion from decision-making is what separates successful investors from those who let their emotions drive them to make poor choices. Here's a tip. Create a plan and stick to it. A clear strategy will help you avoid making rash decisions in the heat of the moment. Knowing your risk tolerance, having realistic expectations, and having a diversified portfolio will keep your emotions in check. It's like having a map in your hand while navigating through a stormy sea. You'll feel more confident and capable of managing whatever comes your way. In summary, the psychological side of investing is just as important as the financial side. Fear and greed will always be there, but if you learn to recognize them and manage your emotions, you'll become a much more effective investor. Stay focused, stay calm, and remember, patience and emotional control are key to success. Part 7. Risk and Opportunity. As you progress in your investment journey, one thing becomes clear. There is no such thing as a perfect investment. Every decision you make comes with some degree of risk. Whether you're buying stocks, bonds, real estate, or even cryptocurrencies, every investment carries its own set of potential rewards and dangers. Here's the thing about risk. It's unavoidable. But what truly separates successful investors from the rest is how they manage risk. Risk isn't your enemy. In fact, it's an essential part of the investing game. Without it, there wouldn't be any opportunity. The real challenge is understanding and controlling that risk. Let's break it down. You've probably heard the saying, the higher the risk, the higher the reward. And while that can be true in many cases, it's not always as simple as that. Just because an investment seems risky doesn't automatically mean it will yield high returns. Similarly, just because an investment is low risk doesn't mean it won't bring decent returns over time. Risk is all about managing your expectations. It's about understanding how much loss you're willing to accept in pursuit of potential gains. You don't want to be overly aggressive and risk everything, but you don't want to play it so safe that your money just sits there, not growing. One of the best ways to manage risk is through diversification. You've heard this term before. Don't put all your eggs in one basket. Diversifying your investments is one of the smartest ways to reduce risk. By spreading your money across different asset classes like stocks, bonds, real estate, and precious metals, you can minimize the impact of a downturn in any one area. If one part of your portfolio suffers, other parts might still perform well, which helps balance the overall risk. Now, let's talk about risk tolerance. Everyone has a different level of risk they're comfortable with. Some people are risk-averse and prefer the security of stable bonds or real estate, while others are willing to take on more risk in exchange for potentially higher rewards, like in stocks or crypto. Understanding your own risk tolerance is crucial in shaping your investment strategy. It's important to be honest with yourself about how much risk you can handle, both financially and emotionally. Here's where opportunity comes in. Risk and opportunity go hand in hand. Every risk you take has the potential for reward, but only if you approach it wisely. Successful investors are always looking for those opportunities where the risk is manageable and the potential for reward is high. They don't shy away from risk altogether. They analyze it, understand it, and then make decisions based on that analysis. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." This is one of the most important principles in investing. During market downturns, when everyone is selling in panic, that's often when you can find the best opportunities. The key is not to let fear drive your decisions, but to recognize that market dips can be opportunities in disguise. So how do you spot these opportunities? First, you need to do your research. Whether it's evaluating a company's fundamentals or understanding the potential of a new market, knowledge is power when it comes to assessing risk and finding opportunities. Don't just follow the herd. Make decisions based on data, not hype. Second, you need to be patient. Opportunities don't always happen overnight. The best opportunities often take time to unfold. Whether you're investing in stocks, bonds, or real estate, remember that investment success is about playing the long game. Don't rush into decisions. Take your time, analyze the market, and make sure you're comfortable with the risks involved. In summary, risk and opportunity are two sides of the same coin. By managing risk effectively, diversifying your investments, and staying patient, you can unlock opportunities that help you grow your wealth. It's not about avoiding risk altogether, but about understanding it, managing it, and using it to your advantage. Part 8. Learning from investment failures. As you continue on your investment journey, you begin to realize something important. Failure is inevitable. You won't always make the right choices, and you might face some losses along the way. The market doesn't always go in your favor, and sometimes things will go wrong. But here's the thing. Failure doesn't define you. In fact, some of the most successful investors have had their fair share of mistakes. The key is learning from those failures and not letting them stop you. Think back to your first investment. Maybe you bought a stock and watched it drop in value almost immediately. How did that feel? Were you panicked? Did you question your decision? That's a feeling that almost every investor has experienced at some point, and it's completely normal. Failure in investing is part of the process. In fact, it's often the greatest teacher. Instead of letting failure knock you down, use it as a lesson. Every mistake, every loss is an opportunity to learn and improve. The best investors are those who have failed the most, but they've also learned the most from their failures. They understand that failure is not the end. It's just part of the learning curve. Here's the important part. Don't dwell on the losses. Yes, they hurt, and yes, it's frustrating, but they don't define your future. The key is to move forward, not backwards. You've learned valuable lessons about risk, about making decisions, and about how to handle the emotions that come with investing. Now, you're better equipped to make smarter, more informed decisions in the future. One of the biggest lessons you'll learn is that not every investment will be a winner, and that's okay. You might have invested in a company that seemed promising, but then its stock plummeted. Or perhaps you bought a property that didn't give you the returns you expected. These setbacks happen. But what you do next is what matters. The most successful investors have faced these types of setbacks, yet they kept going. They didn't quit. They adjusted their strategy. Another key takeaway from failure is that it's essential to diversify. If all your investments are in one basket, a single failure could hurt you much more than if your portfolio is spread out. Diversification reduces the impact of any one loss on your overall wealth. This is why, as you move forward, you need to constantly evaluate and adjust your portfolio to ensure it's well-balanced. And don't forget to manage your emotions. When things go wrong, it's easy to act out of fear or frustration. It's tempting to sell off your investments in a panic, especially if they're losing value. But that's when you need to step back and ask yourself, is this decision based on logic or emotion? Remember, emotions can cloud judgment, and making decisions from a place of fear or anger rarely leads to good outcomes. When things aren't going well, take a moment to breathe, reflect, and think strategically. One final point: failure is temporary. Every setback is just one chapter in your investment story. The long-term story is what matters. You might face challenges, but the goal is to keep learning, adjusting, and growing. The path to success is filled with bumps along the way, but it's these bumps that will help you become a better investor in the long run. So, when you face failure, don't be afraid to embrace it. Learn from it, adjust your strategy, and move forward. Failure isn't the end of the road, it's just a detour. You'll come out stronger, smarter, and more prepared for the next step. Part 9. Recognizing growth markets. As you become more comfortable with investing, you'll soon realize that one of the biggest opportunities for growth lies in growth markets. These are sectors or industries that are expanding rapidly, often fueled by technological advancements, changing consumer behavior, or new government policies. Identifying and investing in these markets early can lead to significant returns, but the key is knowing how to spot them. A growth market is essentially a market where the demand for products, services, or technologies is rising at an accelerating pace. These markets are often driven by innovation, new technologies, new ways of doing things, or changes in society that create entirely new business opportunities. And as an investor, identifying these growth markets is one of the best ways to maximize your returns. Take, for example, the rise of the technology sector over the past few decades. Companies like Apple, Google, Amazon, and Tesla all thrived because they were part of markets that were growing rapidly due to advancements in technology. These companies didn't just ride a wave, they created the wave. If you were able to identify this growth early on and invest in these companies, you would have seen substantial returns. But how do you recognize these growth opportunities before they become obvious to everyone else? Innovation and technology are often the first signals that a market is about to explode. Think about the internet boom of the 1990s or the rise of artificial intelligence today. These technologies are transforming industries across the board: healthcare, transportation, entertainment, and even finance. When a new technology or product starts gaining traction, it can signal a shift in the market that will offer tremendous investment opportunities. Another key factor to watch for is demand growth. Are people increasingly turning to a new product or service? Are businesses in certain sectors expanding rapidly to meet that demand? A good example is the renewable energy sector. As the world continues to move toward cleaner energy, companies in solar, wind, and electric vehicles are seeing rapid growth. The demand for these technologies is growing quickly, which means there's potential for substantial returns for those who invest early. Competitive advantage and exclusivity are also crucial indicators of a growth market. Companies with a unique product or innovative service often have the potential to dominate their market. These companies enjoy a competitive edge because their product or service is difficult to replicate or highly sought after. Think of Tesla's dominance in the electric vehicle market or Amazon's hold on e-commerce. When you invest in companies with these kinds of advantages, you're often investing in markets that are positioned for long-term growth. Government policy and economic trends also play a massive role in identifying growth markets. New government regulations or initiatives can create demand for certain industries. For example, in many countries, governments are pushing for sustainability and green energy. These policies are creating opportunities for renewable energy companies to thrive. As an investor, recognizing these economic shifts can give you an edge in identifying where to put your money. So, how do you actually take advantage of these growth markets? It starts with research. You need to keep an eye on emerging technologies, societal trends, and government policies. Pay attention to news and reports, read market analysis, and look for signs of growing demand in certain industries. But don't just follow the herd. Look for markets where the potential for growth is still under the radar. This is where the biggest returns lie. Index funds that focus on emerging industries are a great option for investors who want exposure to growth markets without the risk of picking individual stocks. These funds group together stocks from companies in growing sectors, giving you diversified exposure to the entire market. Another strategy is to invest in ETFs, exchange-traded funds, that focus specifically on sectors like renewable energy, technology, or biotech. These funds allow you to invest in multiple companies at once, reducing the risk of individual stock selection while still benefiting from growth. In summary, recognizing growth markets is one of the most important skills you'll need as an investor. It's not about chasing the next trend, it's about spotting opportunities that can generate significant returns over the long term. By staying informed, doing your research, and focusing on industries that are set to boom, you'll be well on your way to building wealth in the most exciting markets. Part 10. The Power of Patience. As you've experienced so far in your investing journey, one of the most crucial lessons is the power of patience. Investing is often portrayed as a quick way to get rich, but the reality is far different. The truth is, investing is a marathon, not a sprint. It requires time, discipline, and most importantly, patience. At the beginning, you might feel the urge to make quick decisions, to jump in and out of markets based on the latest news or trends. The excitement of watching your portfolio grow can be overwhelming, but quick gains often come with high risks, and in most cases, they're unsustainable. True wealth is built over time through careful decisions, steady investments, and, above all, patience. Think about the story of Warren Buffett. He didn't become one of the wealthiest individuals in the world overnight. He didn't try to time the market, nor did he panic when the market fluctuated. Instead, Buffett made calculated decisions and held on to his investments for the long term. He understood that the power of compounding, coupled with time, would reward him. And indeed, it did. His wealth grew exponentially, but it was because he allowed his investments to grow over time, without interference. Patience allows you to ride the waves. It's normal for the stock market or any investment to go through ups and downs. If you panic every time there's a dip, you might make decisions you'll regret. But if you stay the course, keep your strategy in mind, and don't get distracted by short-term noise, you'll likely see better results in the long run. The markets will go up, they'll go down, but over time, the value of good investments tends to rise. Patience also helps you stay disciplined. It's easy to get caught up in the hype when everyone around you is talking about the latest stock pick or investment craze. But jumping from one trend to another can lead to poor decision-making. Patience means sticking to your strategy, even when others are getting caught up in the frenzy. It's about trusting your research, your strategy, and your goals. Another reason why patience is so important is that it gives you time to learn from your mistakes. Early on, you might make decisions that don't work out as planned. Maybe you picked the wrong stock, or maybe you failed to diversify properly. Instead of giving up, patience gives you the opportunity to reflect, adjust your strategy, and move forward with newfound knowledge. And here's another powerful reason why patience matters. It helps you avoid emotional decisions. As we've discussed, emotions like fear and greed can often cloud your judgment and lead to decisions you might regret. But patience allows you to step back, evaluate, and think things through logically. It helps you stick to your strategy and not get swayed by short-term fluctuations or the latest market panic. So, how can you practice patience in investing? Here are a few tips. Set clear goals. Know why you're investing and what you're aiming to achieve. Having a goal helps you stay focused and not be swayed by momentary distractions. Stay diversified. Don't put all your eggs in one basket. A well-diversified portfolio reduces the risk of any single loss affecting you drastically, allowing you to ride out market fluctuations. Don't obsess over short-term changes. Check your portfolio regularly, but don't overreact to daily or weekly market movements. Long-term growth is what matters most. Trust the process. Understand that investing is a journey and success takes time. Stay disciplined and trust in the strategy that has been proven to work over time. Celebrate small victories. You don't need to see huge returns right away. Celebrate small gains and remember that every small step is getting you closer to your larger goal. In conclusion, patience is your greatest ally in the world of investing. It helps you weather the storm, avoid emotional decisions, and give your investments time to grow. Remember, great things take time, and your patience will be rewarded as your wealth grows steadily over time. Part 11. Investing in yourself. As you continue your journey as an investor, one key concept that often gets overlooked is that investing in yourself is just as important as investing in stocks, bonds, or real estate. In fact, it might be the most valuable investment you can make. You can learn all the strategies and tricks in the world, but if you don't invest in your own growth and knowledge, it will be much harder to achieve long-term success in any investment. Why is investing in yourself so critical? Well, let's look at it from this angle. Your knowledge, skills, and mindset will directly affect the quality of your investments. Think of it like this. No matter how great an investment strategy is, if you don't have the right mindset or understanding, you'll likely struggle to implement it effectively. Let's break down the different areas in which you should invest in yourself to become a better investor. Investing in knowledge. First and foremost, investing in knowledge is a game changer. The world of investing is vast, and there's always something new to learn. Whether it's reading books, attending seminars, or taking online courses, the more you learn, the more confident you'll become. The best investors are lifelong learners. They're constantly educating themselves, adapting to new trends, and staying up to date with market developments. Imagine trying to build a house without knowing how to use the tools properly. You wouldn't do that, right? It's the same with investing. Your knowledge is your tool set. The more you educate yourself on market fundamentals, valuation techniques, and economic trends, the more capable you'll be of making smart decisions. So, don't hesitate to spend time and money on courses, books, and other educational resources. Investing in decision-making skills. Another essential area to focus on is decision-making skills. Successful investors make decisions based on logic, research, and analysis, not emotions or impulses. You need to develop a systematic approach to decision-making. This means learning how to assess risks, how to evaluate different investment opportunities, and how to choose options that align with your long-term goals. By improving your decision-making abilities, you'll be better equipped to handle the inevitable ups and downs of investing. You won't be swayed by the latest market news or emotional reactions. Instead, you'll be making choices based on your well-thought-out strategy. And remember, great decision-making isn't just about knowing what to do, it's also about knowing what to avoid. Investing in a positive mindset. A positive mindset is another fundamental part of investing in yourself. The financial markets are filled with uncertainty, and it's easy to get discouraged when things aren't going your way. However, a positive mindset allows you to persevere during tough times, see setbacks as opportunities to learn, and stay focused on the bigger picture. A growth-oriented mindset can help you bounce back from mistakes, adapt to changing conditions, and remain calm when the market gets volatile. You'll be less likely to panic during downturns and more inclined to look for the lesson in every challenge. Resilience is a key trait that the most successful investors possess, and it's a trait you can develop over time. Investing in time management. Time management is another crucial skill for an investor. The world of investing can be overwhelming with all the research, market tracking, and decision-making required. But managing your time effectively will allow you to balance your investing activities with the rest of your life. You don't have to spend every waking moment staring at stock charts or watching market news. By setting aside specific times for research, analysis, and portfolio reviews, you can avoid burnout while still staying on top of your investments. Effective time management also means knowing when to delegate tasks. If you're serious about investing, you may want to consider hiring a financial advisor or working with other experts who can help you make better decisions. Investing in skills outside of finance. Finally, it's also important to invest in skills outside of finance. A well-rounded person makes a better investor. For example, learning how to manage your personal finances, improving your communication skills, and even learning how to negotiate better deals can have a huge impact on your success. These skills will not only help you with your investments, but will also make you a better leader, entrepreneur, or business owner. By expanding your skill set, you're preparing yourself for long-term success, both in investing and in other aspects of life. The more you invest in yourself, the more you will be able to capitalize on opportunities as they arise, and the more you will be able to weather the storms when things get tough. The benefits of investing in yourself. When you invest in yourself, you're building a solid foundation for everything else in your life. The more knowledge you have, the better decisions you'll make. The more resilience you develop, the more success you'll achieve. And the more skills you master, the more opportunities you'll open up for yourself. In conclusion, investing in yourself is the best investment you can make. By dedicating time and energy to developing your skills, knowledge, and mindset, you'll set yourself up for success in every aspect of life, including investing. So make sure that as you're building your portfolio, you're also building yourself. The returns on this type of investment are immeasurable. Part 12. Investing and Financial Freedom. As you continue your investment journey, you'll soon realize that one of the ultimate goals of investing is financial freedom. Imagine a life where you don't have to worry about money, where your investments generate enough income to support the lifestyle you want without the need to work tirelessly. That's the dream. But how do you achieve it? Financial freedom doesn't happen overnight. It requires planning, discipline, and a clear investment strategy. The key is to build your wealth in such a way that it generates passive income. Income that comes from your investments, not from your paycheck. This means investing in assets that provide regular returns without requiring your active participation. One of the best ways to start working toward financial freedom is by investing in income-generating assets. These could be dividend-paying stocks, rental properties, or even peer-to-peer lending platforms. The goal is to set up streams of income that don't require you to trade your time for money. Let's talk about dividend stocks. These are shares of companies that pay out a portion of their profits to shareholders in the form of dividends. If you invest in a solid portfolio of dividend-paying stocks, you can generate a regular income stream without having to sell your investments. Over time, this can add up to a substantial amount of passive income. Another way to generate passive income is by investing in real estate. Rental properties are a fantastic way to build wealth over time while providing you with steady cash flow. Rental income can be a reliable source of passive income, especially if you choose properties in high-demand areas. However, it's important to keep in mind that real estate comes with responsibilities, property management, maintenance, and potential vacancies. That's why it's important to do thorough research before diving into the world of real estate. Another option is real estate investment trusts, REITs. These are companies that own and operate real estate, and they pay out a portion of the rental income to investors in the form of dividends. REITs provide a way to invest in real estate without the hassle of managing properties directly. But let's not forget about bonds and other fixed income investments. These might not be as exciting as stocks or real estate, but they are a solid way to generate predictable, passive income. When you invest in bonds, you're lending money to companies or governments, and they pay you interest over time. While the returns are typically lower than stocks, they are a much safer option, making them a great addition to a diversified portfolio. Achieving financial freedom also involves building a diversified portfolio. You want a mix of assets, stocks, bonds, real estate, and other investments that will continue to grow over time. The beauty of diversification is that it helps spread out your risk, so if one investment takes a hit, others will help keep you on track. But achieving financial freedom isn't just about investing, it's also about managing your expenses. Even if your investments are generating passive income, you'll need to make sure your lifestyle aligns with your financial goals. It's essential to live below your means, save diligently, and avoid accumulating unnecessary debt. The more you focus on managing your spending, the quicker you'll be able to reach your financial freedom goal. It's also important to have a financial plan. Knowing your goals, whether it's retiring early, buying a dream home, or building a charitable foundation, will help you shape your investment strategy. Your financial plan should be detailed and flexible, allowing you to adjust as life changes. It should include your investment strategy, a savings plan, and a path for managing taxes and debt. Finally, patience is key. Financial freedom won't happen overnight. But if you stay disciplined, keep investing regularly, and let your wealth grow over time, you'll eventually reach a point where you don't have to rely on a paycheck anymore. Your investments will generate enough income to cover your living expenses, giving you the freedom to do what you love without financial constraints. In summary, investing for financial freedom is about creating a system where your money works for you. It's about building passive income streams through smart investments, living below your means, and being patient as your wealth grows. With a solid investment strategy and a commitment to your financial goals, you can achieve the freedom to live life on your terms. Part 13. Advanced Investment Strategies. As you grow more experienced in investing, you'll realize that sticking to basic strategies will only get you so far. Once you've gained a solid foundation in the basics, stocks, bonds, real estate, you'll want to explore advanced strategies that can help you maximize returns and minimize risk. These strategies aren't for the faint of heart, but if you approach them with the right knowledge and caution, they can significantly enhance your investment portfolio. One of the most effective advanced strategies is asset allocation. This is the practice of spreading your investments across different asset classes, such as stocks, bonds, real estate, and alternative investments, in a way that balances your risk and return. The key to successful asset allocation is finding the right balance for your individual risk tolerance and financial goals. By diversifying your investments, you can reduce the impact of a downturn in any one sector and increase your chances of steady, long-term growth. Another advanced strategy to consider is international investing. While many investors focus on domestic stocks and bonds, there are significant opportunities in global markets. International investing allows you to tap into the growth potential of emerging markets, such as those in Asia, Africa, and Latin America. These markets are often growing at a faster pace than more developed economies, and by investing in international stocks or funds, you can gain exposure to these high-growth regions. However, international investing does come with its own set of risks, such as currency fluctuations and political instability. That's why it's essential to do thorough research and diversify across different regions to manage these risks. Global funds and exchange-traded funds, ETFs, can provide a convenient way to invest in a variety of international markets without the need for in-depth knowledge of each individual country. Another powerful strategy is investing in growth stocks. Growth stocks are shares of companies that are expected to grow at an above-average rate compared to other companies in the market. These companies often reinvest their profits back into the business to fuel further growth rather than paying out dividends. While growth stocks can provide high returns, they also come with higher volatility. It's important to choose growth stocks wisely, focusing on companies with strong fundamentals, innovative products or services, and a track record of consistent growth. Alongside growth investing, you might want to consider value investing. This strategy involves buying undervalued stocks, companies that are trading below their intrinsic value. The idea behind value investing is that the market sometimes undervalues certain companies, and over time, their stock prices will rise to reflect their true worth. Warren Buffett is the most famous proponent of value investing, and it's a strategy that has made many investors a fortune. Value investing requires patience, as it may take years for a stock to reach its true value, but the rewards can be substantial. Alternative investments are another avenue to explore in advanced investing. These include assets like hedge funds, private equity, commodities, and cryptocurrency. While these investments are typically higher risk and may require higher capital, they can provide diversification and unique growth opportunities. For example, hedge funds use complex strategies to generate returns regardless of market direction, while cryptocurrencies have become an increasingly popular alternative to traditional investments in recent years. However, alternative investments can be highly volatile, so it's essential to conduct thorough research and understand the risks before diving in. A strategy closely related to advanced investing is options trading. Options allow you to buy or sell a stock at a predetermined price within a certain time frame. They can be used for hedging, speculation, or generating income. However, options trading is complex and carries a significant level of risk, so it's not something to dive into lightly. It's essential to have a strong understanding of options before using them as part of your strategy. Lastly, tax optimization strategies are vital for advanced investors. The way you manage taxes can have a significant impact on your investment returns. By investing in tax-advantaged accounts like IRAs, 401ks, or Roth IRAs, you can reduce the taxes you pay on your investment gains. Additionally, you can engage in tax loss harvesting, where you sell investments at a loss to offset gains and reduce your taxable income. Tax planning should be an ongoing part of your investment strategy to ensure that you keep more of your returns. In summary, advanced investment strategies are tools that experienced investors use to enhance their portfolios and achieve greater financial success. These strategies can help you maximize returns, reduce risks, and diversify your investments. However, they require knowledge, careful planning, and a solid understanding of the risks involved. Whether you're considering international investing, growth or value investing, or alternative investments, it's essential to approach these strategies with caution and ensure they align with your long-term financial goals. Part 14. Managing your assets after success. As your investment journey progresses and your wealth begins to grow, one of the most crucial skills you'll need to develop is asset management. The truth is, managing your assets after achieving success can be just as challenging, if not more challenging, than building that wealth in the first place. Once you've accumulated a substantial portfolio, the next step is ensuring that your assets continue to grow while also protecting them from potential risks. First, let's talk about rebalancing your portfolio. As your wealth grows, the initial allocation you set for your investments might no longer align with your current goals or risk tolerance. For example, if you started with a higher percentage of stocks in your portfolio but your portfolio has grown significantly, you may now have a higher allocation of stocks than you're comfortable with, exposing you to more risk. Rebalancing means adjusting your portfolio to maintain your desired asset allocation. This is something you'll need to do regularly to ensure your investments align with your changing financial situation and goals. One of the most important aspects of managing your assets is creating an emergency fund. Even though you've reached a point where your investments are generating wealth, life can still throw unexpected curveballs. Medical expenses, family emergencies, or even unexpected market downturns can lead to financial challenges. By setting aside a liquid emergency fund, you can protect yourself from the need to sell off investments during a crisis. Experts recommend having enough to cover at least 6 months to a year of living expenses in case of emergencies. Another essential step in managing your wealth is investing for the long term. Even though you've experienced financial success, the temptation to start living a lavish lifestyle can be overwhelming. However, it's crucial to maintain the habits that got you here in the first place: disciplined saving, smart investing, and living below your means. In fact, the most successful people often continue to live frugally despite their wealth. They understand that true financial success comes from the ability to generate wealth consistently, not just spend it all. A powerful tool in managing your wealth is tax optimization. The more successful you become, the more likely you are to face high taxes on your investment gains. That's why it's important to engage in tax-efficient investing. You can make use of tax-advantaged accounts like IRAs or 401ks, or consider tax loss harvesting, where you sell losing investments to offset gains and reduce your taxable income. Working with a tax advisor can help you develop strategies to minimize your tax liability and keep more of your hard-earned wealth. Now, as your portfolio grows, you should also consider estate planning. This includes setting up a will, establishing a trust, and determining how you want your assets to be distributed upon your passing. Estate planning ensures that your loved ones are taken care of and that your wealth is passed on according to your wishes. It also helps you avoid the lengthy and costly probate process that can drain your estate's value. Many people overlook estate planning until it's too late, but having a solid plan in place will ensure that your financial legacy is preserved. Real estate is another crucial area of asset management. Many successful investors find that their real estate holdings represent a significant portion of their wealth. It's important to not only manage these assets carefully, but also think about how to maximize their value over time. Property management, regular maintenance, and strategic renovations can all help increase the value of your real estate portfolio. You should also keep an eye on market trends to ensure you're not overexposed to any one location or type of property. One common mistake successful investors make is ignoring their cash flow. While it's exciting to see your investments grow, it's also important to manage your liquidity, how easily you can access your money when you need it. You want to avoid a situation where your wealth is tied up in illiquid assets, such as real estate, where you can't easily access funds if needed. Maintaining a balance between investments that offer high returns and those that provide liquidity is critical for managing your wealth effectively. Lastly, don't forget to invest in your personal development. As your wealth grows, the challenges you face will change. To continue succeeding, you'll need to grow alongside your financial portfolio. That means continuing to educate yourself, developing new skills, and staying up to date with changes in the investment world. The more you invest in yourself, the better prepared you'll be to manage your growing wealth and the opportunities it brings. In conclusion, managing your assets after success is all about maintaining balance, discipline, and strategic planning. Your wealth is a tool, and it's up to you to manage it wisely. By focusing on rebalancing your portfolio, maintaining an emergency fund, optimizing taxes, and planning for the future, you can ensure that your wealth continues to grow and serve you in the long run. Remember, success isn't just about building wealth. It's about preserving and managing it to secure your financial future and the future of those you love. Part 15. Reflecting on the journey and looking ahead. As you reach this point in your investment journey, it's time to pause and reflect on everything you've learned, accomplished, and achieved. The road hasn't always been easy, and there's still much more ahead, but you've come a long way. When you look back at the decisions, the risks you took, and the lessons you learned, it's clear that this journey has been about much more than just money. It's been about growth, both financial and personal. You've learned that investing isn't just about picking stocks or assets. It's about creating a mindset, a philosophy, and a strategy that works for you. It's about learning to make decisions based on knowledge, not emotions. You've learned that patience is not only a virtue, but a critical component of long-term success. And, most importantly, you've learned that failure is just a stepping stone to greater achievement. Looking back, you might see the mistakes you've made. Maybe you rushed into a decision, or perhaps you didn't diversify enough. Maybe there were times when you let fear or greed guide your choices, and the outcome wasn't what you had hoped. But every single one of those experiences has shaped you. It's easy to regret failures, but remember that each mistake has made you a smarter, more resilient investor. It's a part of the process, and it's what makes you stronger. But now, looking ahead, it's clear that you're in a position of power. Your investment strategy is stronger, more diversified, and more aligned with your goals than ever before. You've taken the time to understand your risk tolerance, and you've invested in both your knowledge and your portfolio. You've learned to manage your emotions and stay disciplined. And as a result, you've set yourself up for long-term financial success. The road ahead is filled with opportunities. The world of investing is constantly evolving. New industries emerge, technologies develop, and global markets shift. But the one thing that doesn't change is that investing remains a journey. There will always be challenges, opportunities, and changes. The key is to remain adaptable, continue learning, and always stay true to your strategy and goals. One of the most exciting things about investing is that you can create a legacy. As you continue to build your wealth, you're not just improving your own life, you're laying the foundation for future generations. Whether it's passing on your wealth, sharing the knowledge you've gained, or creating philanthropic opportunities, investing gives you the power to make a lasting impact. It's not just about accumulating wealth, it's about using that wealth to make a difference in the world. So, what's next for you? As you look ahead, the possibilities are endless. Maybe you want to continue growing your portfolio, focusing on emerging markets or high-growth sectors. Perhaps you want to focus on building passive income streams that allow you to step back and enjoy the freedom that comes with financial security. Or maybe you're ready to take your investment journey a step further and start exploring alternative investments like venture capital or cryptocurrency. The important thing is that you now have the tools, knowledge, and confidence to make these decisions. Whatever path you choose, remember that investing is a lifelong journey. The more you learn, the more you'll be able to adjust your strategy and adapt to new circumstances. The key is to stay disciplined, patient, and focused on your long-term goals. As you continue to evolve as an investor, so too will your wealth and your impact on the world. And while the future is full of uncertainty, you now have a better understanding of how to navigate that uncertainty. You've equipped yourself with the knowledge and skills needed to face whatever challenges come your way. It's no longer about worrying over what's next. It's about embracing the journey and continuing to take calculated steps forward. So, as you step into the future, keep these words in mind. Stay committed, stay patient, and continue investing in yourself. Because no matter what happens, the path you've chosen, this journey of investing, will lead to financial freedom, success, and the opportunity to leave a meaningful legacy. Congratulations on reaching this point. The journey doesn't end here, it's just beginning.